So financial institutions get a lot of flack these days from all sides. After all, they caused the financial crisis and they'll probably cause another one soon. They kick people out of their homes, Ebenezer Scrooge style. At times, they cause the death of companies, the destruction of lives, and the perversion of our economic system. They're cold and heartless, short-sighted profit machines. And you know what? I'm not even here to tell you that that's false, per se. The natural question arises, however, why on earth do we even have this hyper-destructive economic subsystem to begin with? I mean, it really seems at times like all it exists to do is just make rich people richer. In this video essay, I submit to you that financial industries are destructive neither by definition, nor by nature, nor by design, but rather they become destructive through the complete ambivalence and inaction of regulating authorities. They're destructive only insofar as the economy as a whole mismanages them. In actual fact, finance is super useful, maybe even completely necessary. Let's talk about it and figure out why. If you've ever gotten a car loan or a mortgage, borrowed money from your parents, or even put some big purchase on a credit card, you know exactly how important access to finance can be in the life of an individual. You kind of need to buy something right now, and maybe you could afford it if you spent some time to save up, but you just don't have the cash when you need it. So someone else agrees to buy it for you right now, as long as you promise to pay them back for it later. On a basic level, this is quite literally all that finance is, no matter what form of finance we're talking about. It's all different shapes and colors of borrowing. It's pretty easy to understand instinctively when presented in this way, but we have to go one step deeper to really understand why finance is important for the economy. Let's take the example of a home mortgage. You have a house. It's worth a lot of money, and that money is part of your wealth. It's part of the total value of everything that you own. It's an asset. But you can't use it to buy anything. Maybe you really need to buy a new car, or maybe you want to start a business. You can't spend your house to do that. You need cash money. Money is also an asset. It has value just like your home does. One of the main differences between them is that you can pretty easily give your money away in exchange for something else. You can't do that with a house. Because of this, money is what we call a liquid asset. It can easily flow like water from person to person, making the economy function. In order to do this with your house, an illiquid asset, you first have to sell it for money, or liquidate it. The downside is that you need your house. If you sell it, you don't have anywhere to live. This is where the mortgage comes in. You can temporarily give ownership of your house to a bank in exchange for cash, and when you pay back what you owe, then you get total ownership of your house again. The house works in this case as collateral to make sure that you hold up your end of the deal. Looking at it another way, the financial markets allow you to turn an illiquid asset, your house, into a liquid asset, money, without losing the illiquid asset in the meantime. This is the true purpose of finance. It provides liquidity to the economy. Now, liquidity is super important. An economy isn't strong because people own expensive things, no. It's strong because people produce lots of stuff and get paid for it. That requires people to A, have liquid assets, money, and B, spend it on things. In a world where people own expensive stuff, the fact that something like a mortgage is an option will mean that a lot more people will have the financial opportunity to, for example, start a business. And there will be a lot more economic activity as a result of that. It's not just good for individuals, though. Businesses and corporations own expensive stuff too, like buildings, machinery, even the organizational structure of the business itself can be seen as a thing of value since it can be used to earn money. Imagine you own a small chain of restaurants and there's a really good opportunity for you to expand right now. Maybe some restaurant in a nearby town is closing and you want to buy the property to set up another location. If you wait too long, that opportunity is lost, but you just don't have the cash to do it right now. You're barely making enough to cover all of your operating costs. So you can go to a bank, use your illiquid assets like ownership of your business as collateral, and get enough cash to expand. Hopefully, once you've set up that new location, you'll be earning more money and you'll be able to pay back the loan. And there are more ways that businesses can raise money with finance. They can offer to sell small fractions of the ownership of their company to the public in order to raise money. That's what stocks are. They can also go to the public and ask people to lend them money, relying on their reputation as an upstanding and successful business to get people to trust that they'll pay you back. That is just selling corporate bonds. No matter how they do it, though, that business now has an opportunity to expand, become more successful, and potentially contribute more to the strength of the economy. All thanks to the fact that finance is a thing. Now, that's all pretty cool, but hold on to your hats, because we're going to go one step deeper still. Now imagine that you own a bank. You've got a lot of money, but you lend it out to people. When you provide Jimmy with his mortgage, he has to pay you back, and the legal rights to receive those payments are an asset that you own. But it's an illiquid asset. Maybe the economy is booming right now and everybody wants to borrow money, but you don't have any left. You could just say, nope, sorry, no more loans. But that's just going to waste the opportunity for economic growth when those people aren't able to get the money they need to start a business or buy a car or whatever. Not to mention the opportunity for you to earn money by collecting interest. Instead, what you want to do is find someone with extra cash who wants an illiquid asset that earns interest. Then you sell them the rights to Jimmy's mortgage so that they can get the payments from it in exchange for cash, liquid cash. Now, like magic, you can give another loan or invest in something, maybe even something that has a better return rate than Jimmy's mortgage. When assets get traded around like this all over the economy, it allows the market to be more dynamic and productive by moving liquid cash from people who have a lot of it and nothing to do with it into the hands of people who have a lot that they want to do, but just not enough cash. Now, financial markets are important precisely because they are more liquid than other markets. In other words, they are very efficient at moving assets around. Because of this, having financial markets as part of the economy is kind of like oiling up your bike chain. Yeah, the gears and the chain of your bicycle might work and they might get you moving, but lubricating it with oil makes it move better with less resistance. It makes it more efficient. Unfortunately, that gap in efficiency between financial markets and real markets is also what allows finance to become so economically destructive. As Dr. Ha-Joon Chang put it in his book 23 Things They Don't Tell You About Capitalism, efficiency is usually the name of the game when it comes to economics, but financial markets have simply just become too efficient. Financial deregulation has been the dominant growth strategy for countries around the world starting in the 1980s, but really picking up steam in the late 90s. The idea was that financial markets are really good at earning profits, so if you let them do whatever they want, then your country will become richer. And that actually worked really freaking well, until all of a sudden it didn't. And the problem is that financial markets on their own don't do anything useful. So building success on a foundation of finance is just setting your economy up for collapse in the future. Instead, what they do is they help other things work a lot better. In order to do that, however, they have to be plugged into real markets so that they can help move those assets around. But what happens when something in a real market starts to go wrong? Thanks to their superior ability to move assets around, financial markets can just get the heck out of there instantly before things get any worse. The age of computers and the internet has only made this even faster. On the other hand, those businesses and the people in those real markets can't move anywhere nearly as quickly. It takes time for them to sell things that they don't need, buy things that they do need, and figure out new ways to address new problems. When businesses have been built and become successful thanks to their access to financial markets, those markets running away at the first sign of trouble means that people and businesses are left holding the bag. The rest of the economy moves on without them, and they have no chance to adjust to try to save themselves. This means business failures, market crashes, and loss of wealth that just didn't need to happen. Meanwhile, highly mobile financial markets are making the most money possible at any given moment. On a small scale, this can lead to the unnecessary failure of a couple of businesses and maybe a bank or two, but when it gets a bit bigger, it can cascade into something like the 2008 financial crisis. It is absolutely true that letting financial markets run rampant can lead to catastrophic economic events. On the other hand, not having them at all will lead to economic stagnation where communities and markets have a really hard time being able to grow and adapt to the realities of a changing world. This can also cause catastrophic failures, but with the added downside of no financial markets to provide the extra liquidity necessary to dig yourself out of that hole. The solution, as with pretty much everything in life and economics, is to find a happy middle ground. Not enough financial freedom causes problems, but so does too much financial freedom. Financial markets need to be more efficient than real markets in order to do what we need them to do, but there's a point where more efficient becomes too efficient. Serious regulation of financial markets is super important because it slows them down enough so that their potential negative effects can be minimized. Yes, that might mean that the economy won't be able to grow quite as quickly, but it also means that it won't be able to crash and burn quite as easily or dramatically. Look at it this way. There's a reason that we put speed limits on the highway. Your car helps you get from A to B a hell of a lot faster than your feet can, but going too fast causes more problems than it's worth. It's always possible to have too much of a good thing. Hey, thanks for listening. I really appreciate you hanging out and letting me share this stuff with you. I know this video didn't go into too many specifics. I would love to talk more about which kinds of financial regulations are good to use or specific problems in financial markets that can lead to major economic crashes, but I'm trying to cut down on the length of my videos. Covering all of that would have put us here for a good half hour at least. Hopefully I'll be able to talk about those things and much more in the future, but for now, just thank you and I'll see you next time.